Kia ora, my name's Jared Kerr and I'm joined with Mary Jo Vergara and we're economists at Kiwibank. We want to talk to you today about monetary policy and what we think the Reserve Bank of New Zealand's going to do. But first of all, I think it's important to go through what they have done and why. MJ, what has the RBNZ been up to?
So they've done sort of three main things. Firstly, they slashed the OCR, the official cash rate, down to a record low of 0.25%. They've removed LVR restrictions to help people access the mortgage deferral scheme. And they've also done a little bits and pieces to kind of keep the supply of credit flowing so we don't get a financial crisis out of this.
But the economic data is still a little mixed. The mandate of the central bank, which is to, I guess, keep prices stable around 2% over time, but also try and maximise employment in the economy. Both those mandates are moving away from the central bank, with downside risks to inflation and upside risk to unemployment. So it looks like the central bank has to do more. What are we expecting?
Well, they've said that they're not finished with the official cash rate. They've kind of flagged this idea of going into negative territory, which would be the first time in New Zealand. But they've also mentioned doing other bits and pieces, something that's called the Funding for Lending program, another way to kind of get retail rates even lower in the economy.
MJV, what the flip is an FLP?
The FLP is a Funding for Lending program, and it's basically just a program to give retail banks access to really cheap funding as a way to lower the cost of funding, which you'll see lower retail rates throughout.
So banks fund themselves with deposits. Basically, we go to mums and dads and say, give us your hard-earned savings. We'll look after it and pay you an interest rate. That interest rate's the cost of most of our funding. About 60 to 70% of our funding is through retail deposits of mums and dads. The other leftover is made up of wholesale funding, so going to large institutions and again saying, give us some cash. We will then lend it out. But the central bank is potentially going to come to us and say, hey, look, here's another pool of funding, cash, that's really cheap that you can then lend out. And the idea is to lower interest rates again, particularly mortgage rates and lending rates to businesses. And I think we'll see that before the end of the year. So with lower lending rates, of course, there's going to be lower deposit rates, and that hurts some.
Yeah, so you'll have sort of winners and losers with moving the interest rate. And the losers in this, unfortunately, are the savers who, when they put their money into the banks, they'll get very little return, near negligible. I think that's the idea, is to sort of push them out the risk spectrum, but they are going to be hurting. Those trying to save up to buy their first home, those saving up for retirement, they're the ones most hurt from lower rates. Yeah,
absolutely. So in aggregate, lowering an interest rate provides stimulus to an economy, because most of us have got debt, but then the savers are the other ones that hurt, and it becomes that much harder to build a deposit, but it also becomes that much harder to live on your retirement savings when the interest rate just keeps getting ratcheted down. So there is a significant proportion of the society that hurts in this environment, and I think will hurt more if they go negative. So I'm quite negative on negative interest rates. MJV, you like it or like negative on negative interest rates? The reason why we're not huge supporters of negative rates is because of what it does to wholesale markets. So if we get a negative cash rate, don't worry, your deposit in a bank is not going negative, and don't start running around excitedly thinking that we're going to start paying off your mortgage for you. It becomes a wholesale problem. So we'll see large insurance companies, we'll see financial institutions, fund managers having to effectively pay for the privilege of owning government bonds. And I think that puts some stresses in parts of our economy we don't really need. I don't think we need that extra stress at this point in time. Doesn't really matter what I think though. What do we think the RBNZ is going to do?
Well, we think they're going to go first with the Funding for Lending program, see how that works out, but they've still got a preset course and going negative into next year, and we're thinking February as a early move.
Why February? All the other economists are saying later. Why are we earlier?
just to get that shock factor in the market, to go ahead of the curve, ahead of the market.
Absolutely. So if you're going to go guns blazing, you go hard, you go early, and you go to get as much impact in the financial markets as possible. So if the RBNZ was to cut in February, it's not fully expected by market traders. So you would see interest rates gap lower on the surprise move, and you would also see the currency come under pressure, which is exactly what the Reserve Bank wants. We want a weaker currency because what does a weaker currency do for Kiwi?
It helps our exporters, and we're an export-led economy, and that'll really help us out.
All right. If they're going to do it, go hard, go early, go February, and let's get that currency lower.